Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome to this episode of the Open Treasury podcast, Paul and Ben.
Thank you, Push.
Thanks, Push.
Thank you for taking the time to share your viewpoint with us on topics that impact the world of treasury management and beyond. In today's episode, we will discuss 4 topics, namely 7 crucial insights into growth corporates and their working capital needs, UK-based retail investors losing faith in the Bank of England's decision-making, worldwide financial cost of crime compliance for financial institutions hits US $206 billion, and finally, publicly traded US companies are required to report cyber attacks within 4 days. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's commence today's discussion with our first story for today, which is about 7 key insights into growth corporates and their working capital needs. Most banks tend to classify growth corporates or middle market companies as businesses generating between US $50 million and $1 billion in annual revenue as per the 2023-24 edition of the Growth Corporate Working Capital Index, a Visa report done in collaboration with Payments Intelligence. The report offers insights into the business conditions and working capital solutions of 873 CFOs and treasurers of fast-scaling companies across 5 regions. The working capital solutions comprise 8 financing options that growth corporates use to access external capital. These options encompass working capital loan, corporate overdraft, bank line of credit, corporate and virtual credit card, third-party revolving credit facility, letter of credit and bank guarantee, draw against unused corporate credit line, and invoiced financing and factoring. The report delves deeper to offer 7 crucial observations about growth corporations and their working capital requirements. Paul, of the 7 crucial observations that are covered in the article about growth corporations and their working capital requirements, from a middle market treasury department perspective, which do you consider the most important?
Well, Push, I always gravitate towards your existing third-party relationships, and it depends on the particular industry or company you work within. It may be bank relationships that matter most, or it could be supply chain financing that matters most. Having a line of credit with your bank or the ability to access credit through a revolver or a letter of credit or some kind of guarantee, I think is essential for organizations. And many times what you'll find is that they'll have more than one of these levers in place. So it's kind of a multiple parallel paths to an end game to ensure that you have adequate liquidity to manage working capital of an organization where, that's important. Some industries, working capital isn't a thing. I worked for insurance companies, and for insurance companies, working capital just isn't something that you see them worry about because they really don't have working capital, unlike industrial or manufacturing plants. Working capital is extremely important to them. So supply chain financing comes into play when you think about invoice financing or factoring, incentives to get revenues in the door quicker or to be able to satisfy your supply chain obligations to get the needed supplies to manufacture what you're manufacturing. So I think you can leverage these particular items to manage capital on a more adequate basis. And what was interesting in this article is they pointed out how some organizations, they view taking on leverage or utilizing these opportunities to access capital. It's seen as bad. I don't understand that. I like organizations that can leverage these tools to help expand their business, to help it keep running efficiently. And it really does become much more efficient to do it that way versus taking your own capitals. They talked about, as a CFO or CEO of the organization, I want to grow within. I want to use my own capital to fund that. But what they don't realize is the cost of capital to do it that way is much higher. It also doesn't allow you to expand or grow at a rate perhaps investors find appealing. So your return on capital becomes a lot less when you're focused solely on the organization funding, the growth, new product development, expansion. So I think this article does a nice way of laying out. We have multiple levers that you can utilize out there. And if organizations aren't looking at these tools that are available to them, they should have these items lined up. They should look for particular ones that fit their business model best. Like I said earlier, some organizations, it makes more sense to lean on banking partners. In other industries or business lines, it makes more sense to also add on or access through supply chain financing.
Yeah, it's having those levers that you can pull when you need to. You know, you're not just waiting for a rainy day potentially to see if you can optimize your working capital. Certainly, a lot of the growth companies in the report were using lots of different working capital tools to actually help them as a top performing growth company. One that I wanted to highlight is virtual cards, which came up in the report. We've covered a lot of virtual card launches and partnerships on CTMfile. Just last week, we had Visa and Lloyds Bank in the UK partnering to launch a virtual card solution to address businesses' payments and purchasing administration challenges. Back in July, we reported on MasterCard's launch of Receivables Manager, which is an automated solution streamlining how businesses accept and process virtual card payments. And there are many, many more. So I think, you know, that's quite a relatively new tool that certain corporates are finding out about and using and deploying. Particularly, you know, for supplier payments, a virtual card can help automate supplier payments, which can lower costs, accelerate the speed of those payments. And by removing that friction, you can also perhaps improve your business relationships as well. For suppliers, the fact that their payment can be accelerated by a virtual card could mean that they improve their cash flow and unlock their working capital. So it's almost like the corporate in the middle is helping not only themselves but the suppliers as well, which is all good, I think. The only issue, I think there are still some issues with virtual cards that mean they're not operating at quite the peak that they could be. There was a report from Mercator Advisory Group a couple of years ago that at the time, and it could have changed in 2 years, I'm sure it probably has a little bit, but 2021 found that 90% of all virtual card transactions were still being processed manually. So obviously that's kind of undoing a bit of the good work that the virtual card's meant to be doing in the first place. And that's not good for buyer or supplier. So finding that sort of end-to-end automation, the technology side of the working capital piece is really important.
Definitely, when you think about industrial, manufacturing, transportation, logistic businesses, the use of the virtual cards, it's another lever, another way that they can finance and manage the working capital associated with this chain from front end to back end. Even the manufacturers of these parts that are needed by in-supply manufacturers to manufacture the goods that they develop, they need this as well. So transcends across the entire supply chain. And we've seen a lot of changes or greater focus in this area. And I don't know if it was just COVID alone, but I think people were starting to think about supply chain financing before then. But I think COVID actually accelerated the thought process around having to manage this more efficiently, rethinking the ability to have flexibility, where I think supply chains were more rigid in the past, and you need more flexibility today because things change, as we found out, several years ago. Things change, and they continue to change. I think we're starting to enter an era where supply chain logistics is going to become more and more important. So these types of tools to help manage that also get elevated in terms of importance.
Those are great points. From growth corporations or middle market companies, let's shift the conversation to our next topic, which is about UK-based retail investors losing faith in the Bank of England's decision-making. A new survey of 964 UK-based retail investors has revealed that just 39% of UK retail investors trust the Bank of England's decision-making. Less than half think the central bank is right to continue hiking the base rate, while 46% think higher wages are a major factor in fueling high inflation in the UK. As interest rates hikes impact the economy and their investments, less than 2 in 5 UK retail investors have faith in the Bank of England's decision-making, the research commissioned by Capital Markets Group, HYCM, has revealed. The firm commissioned an independent survey of 964 UK-based investors, all of whom have investments of over £10,000, including the value of their savings, pensions, and residential property. Ben, you covered this story for CTMfile. Do you think Bank of England's rate hiking cycle has had a significant impact on retail investor sentiment towards UK's central bank? And from your conversations with corporate executives in England, do you think they share a similar sentiment? If so, isn't this loss of confidence in decision-making really about losing a degree of trust that needs to be rebuilt by the Bank of England by explaining their decision-making to a wider audience and not just financial markets?
Those are great questions, Push. It's certainly a very interesting time for the Bank of England and its Monetary Policy Committee that meets to decide the interest rate. I suppose the good news, maybe, for these investors is that after 14 consecutive rate hikes, the Bank of England decided to pause hiking at September's meeting. But it's quite fascinating because before that meeting, the markets were pretty confidently pricing in another 25 basis point hike. So what happened? Well, the day before the MPC vote, the latest UK inflation data was released. Market expectations were that headline inflation would be up to 7%, but the print that came in for August was 6.7, actually down from 6.8 the previous month. And the core CPI inflation, which kind of excludes energy, food, alcohol, and tobacco, also surprised to the downside, falling to 6.2% from 6.9 in July, and market expectations were for 6.8. So this inflation print seems to have been enough for the MPC to pause its hiking cycle, or just on that one data point, and only just, like the vote. They always release the vote, so you know exactly, what the members were thinking. And it was 5-4. Basically, the governor, Andrew Bailey, casted the deciding vote. So there's still a number of committee members there who preferred to carry on at the kind of the lower hiking pace of 25 basis points. And it's interesting, over the past year, obviously, central banks around the world have been kind of wrestling with how to manage inflation without crushing growth. And frequently, it's the Bank of England is the one that is an outlier or does something unexpected, shocks the markets at what's going to happen. The certain sensitivity of the panel showed towards this single data point does perhaps show that investors are right to be wary of their decision making. And just because they paused in September doesn't mean they won't hike again in the next meeting at the start of November. The wage growth spiral, which is mentioned in this report in the UK, is something that the bank considers, and it is significant. I think the average annual growth in regular pay, excluding bonuses, is at 7.8%. For the last reading, which is kind of the highest growth rate since comparable records began only in 2001, although that's already 22 years ago, shockingly. There's a lot of things at play, and we do often get the unexpected from the Bank of England. So they show they're working. They give you the report of here's what we thought, and here's why the people that voted to carry on hiking voted to do that. But it does seem that out of all of the central banks, I think maybe if you look at the Fed, which has well telegraphed intentions of what it's doing, the ECB similarly is very clear and concise in what it's doing. The Bank of England can be a little bit mischievous, shall we say? So it can be a surprise. So I'm not at all surprised, really, that this particular poll came out with that investor confidence.
Yeah, well, I certainly don't. I'm not as close to the economics of what's going on in England as you are, Ben. But I certainly understand the basis, because what's going on there is going on here in the U.S. And what I can say about people that question central bank decision making is that this is not uncommon. This is kind of what you get in times of stress, that people start questioning are decision makers making the right decisions. From a basic core economic standpoint, the Bank of England is doing exactly what I would expect them to do. We're facing inflation, facing wage growth. It's the same thing here in the U.S. Our central bank decision makers are sitting there trying to figure out, how much longer do we do this? And at what point do we make the decision collectively to pause or stop? And so you have multiple people who sit on these committees that are the decision makers. These are some of the world's top economists. These are people that understand economics, and you have to trust, just like you trust doctors or your lawyer or other people, that they know what they're doing to help make good decisions to give you the best service or care possible. I think our central banks are trying to do that as well. I don't think they take these decisions lightly, because you can't. They have impacts to everyone within a country. The decision making is always going to be scrutinized. At the end of the day, what's going to happen is history's going to tell whether they make good decisions or not. The next step for them, especially as economists, is, do you learn anything from it? And can you make better decisions in the future? Economists spend a lot of time looking at data and information that is typically historical to infer or make decisions. This tends to help them directionally make decisions in a fashion that is reasonable. Now, whether it's correct or not, sometimes there's unknown factors out there that have impacts that you can't control. Like COVID. That's something that we couldn't control. Outside factor that happened that had a great impact on the economics around the world. Like I said earlier, history is going to tell whether the decisions were actually good or not. But what you are seeing with these boards is that not everyone agrees, and that's not a bad thing. That's a good thing, because it's going to help you think in terms of, are we making the right decision or are we not? I think it's working. From my standpoint, from what I can see on the outside looking in, this seems to be working. They seem to be doing things that seem reasonable to me. So we'll see what history says when this all passes.
And certainly for the Bank of England, they, after 14 consecutive rate hikes, they may well have just been very keenly looking for a chance to at least pause, not saying forever, but just take 1 month off of that continuous line going up on the graph. So certainly the more positive than anticipated inflation results the day before certainly gave them the opportunity to do that and take a breath, perhaps, before evaluating what to do next.
Absolutely. And I, for one, I'm glad I'm not in the shoes of anybody who's taking decisions and taking decisions at the Bank of England. Let's move forward to our next topic for discussion, which is about global financial crime compliance costs for financial institutions, totaling more than US $206 billion, according to the latest True Cost of Financial Crime Compliance report from LexisNexis Risk Solutions. This cost is comparable to more than 12% of global research and development expenditure and equates to $3.33 per month for each working age individual on Earth. Financial institutions are spending hundreds of millions of dollars each year on financial crime compliance, and a significant portion of that annual expense is being invested in implementing risk technology into compliance processes. Paul, given the growing complexity around geopolitical risks and compliance regulations, as well as the rise in financial fraud and criminal activity, do you think emerging risk technologies and an emphasis on optimizing the efficiency of payments can together play an important role in mitigating the financial cost of crime compliance?
From a treasurer's perspective, I think it will over time. I think it will have a positive impact. The costs of the compliance side, but also mitigating the risk. It's a necessary cost. Do I think it's going to go down over time? It may. If the efficiencies in using AI technology, machine learning, other tech to help manage that makes it more efficient, costs will come down. But organizations globally have to have a focus in this area. We've talked about this recently. The market cap on the fraudsters, the people that are stealing money from companies and people, is trillions of dollars. It's quite expensive. It's a huge loss. It's bigger than the cost that's being sunk into preventing this and doing compliance. What my hope is that compliance isn't overburdensome, but it's the right amount of compliance, meaning that whether it's disclosures or whether it's having systems and processes in place to help prevent or mitigate the big risks associated with financial loss, I think that's where the focus should be. So you don't want to have compliance be compliance for the sake of compliance, meaning that, well, I've got to do all this stuff because this is what regulators or regulation is saying that I have to do. But, it's really not doing anything to help or prevent the crime. And if that's the case, then the compliance is wrong and it needs to be looked at and adjusted. Some locations, as was pointed out in this article, there are some locations where compliance costs are way higher and some locations way lower. So I think if I'm a regulator and I'm looking at financial crime compliance, I need to look at areas to see, okay, what's working, what's not working. Eliminate the things that aren't working, deploy the things that are working. Try to get that right balance so you're as effective as you can possibly be. In the arena of making investment decisions, you're always taking on some level of risk. But what you want to be able to do is you want to be able to manage the right risks. I think the same applies in this arena. Take that over and you look at it and you say, what are my risks? Am I managing the right risks? Trying to control all of them is almost impossible because we know that fraudsters are learning, they're developing, they're looking for weaknesses, opportunities. They're doing the things that they do to be the best criminal they can possibly be, to steal money. And to say that you're going to have something that's going to prevent any possible loss, it might be super expensive to do that, and it still may not work at the end of the day.
I completely agree, Paul, that particularly from the regulator side and, legislators as well, there needs to be like a collaboration between them and financial institutions to kind of identify, why the costs are particularly huge in certain areas. Something I found quite interesting was obviously we're looking at digital ways to maybe perhaps make the process more efficient and bring down costs a bit. But digital payments are also bringing in new kinds of fraud as well. The report showed that I think 59% of respondents had reported financial crimes from digital payments, 58% for cryptocurrencies, and AI technologies used in 56% of attacks, exploiting vulnerabilities in digital payment systems and manipulating transactions. Yeah, there kind of needs to be an effective collaboration between the thought processes of the technological advances that we have and how regulatory bodies can be quite forward thinking in that regard as well. So I found that was just kind of one nugget from the survey that I found quite interesting.
And that certainly is an important nugget. Those are great insights, Ben and Paul. Moving forward to the fourth news item that features in today's discussion, this as well hovers around risk and compliance and security and fraud, which is about publicly traded US companies required to report cyber attacks within 4 days. Given the surge in cyber attacks in the US and to bolster cybersecurity transparency associated with public companies, including protecting investors from the downside risk and harm that a data breach can cause to such companies, Wall Street's top regulator, the Securities and Exchange Commission, or the SEC, has recently adopted new rules for enhanced and standardized disclosure regarding cybersecurity risk management, strategy, and governance. SEC's new set of rules require registrants that includes US publicly traded companies and foreign private investors to disclose cybersecurity incidents they experience within 4 business days of determining that a cybersecurity incident is material. The SEC deems a security incident as material if it is likely to have a significant impact on the company's business operations, financial position, reputation, or relationship with its customers. Ben, the SEC's new rules on cybersecurity disclosure signifies a fundamental change in how cybersecurity breaches are reported. Do you think these rules will close the gaps in cybersecurity defense and disclosure practices and provide investors more decision-useful information about the cybersecurity risks associated with publicly listed US companies? Or do you think this will be a nightmare for corporations and their treasury departments and perhaps create a web of confusion, ignite litigation, and additional costs?
Great question, Push. It's certainly, on paper, I would say a good thing. Thinking about corporate treasurers, they may not be the people within the organization that are letting the authorities know about the cyber attack, but obviously they are on the front line of payments, which is a key target area for cyber criminals. So treasurers need to have processes in place and the right systems aligned to alert them to any possible breach, scam, or dodgy link that might have been clicked in their department or elsewhere in the organization. But if you think about the 4-day reporting time limit, they also need to push for their organization to have the right reporting structure internally so that any alarm from anywhere within the organization could go through the proper channels and hit the desk of the person responsible for reporting the breach in a timely manner. And that is no easy feat, I would suggest, in some companies where you have huge, middle management tier and different business units in different countries, perhaps, but have touched the US firm at a certain point. There's certainly a reputational risk for a firm associated with a cyber hack. Was there more that could have been done to prevent it, and so on? But I'd say the biggest risk is to have the attack and not report it, because these things always come out, and the reputational risk and the fines that firms could potentially open themselves up to by trying to hide something like that is always going to be far worse. So it's just a matter of, I think, checking that the right procedures are in place. And if they're not, being able to alert senior management, making sure everyone knows what happens. If in the office, the fire alarm goes off, everybody knows what to do, right? So it's like that, but a slightly more virtual example of it. So that's what people need to be looking at.
Well, certainly not surprised to see cybersecurity risk top of this survey in terms of what's front of mind. When I think about this particular article, we touched on in our prior conversation around the need to ensure that you have the right risk mitigation in place. I think from a standpoint of reporting, quite frankly, I think the SEC's 4 days is too long. I think notification needs to be out there publicly to the investors sooner. So my hope is that they take a look at this down the road and they actually close that gap and make it a shorter period. If I'm an investor, getting information sooner is better. Getting it 4 days after it happens, to me, that's problematic. If I get it sooner, I'm able to digest and make decisions around it quicker. Certainly non-disclosure and then having something come out, has been pointed out from a reputational risk standpoint, can be quite significant. People look at that and they start getting skittish around doing business with these companies, these organizations. It used to be you would have something happen with a large publicly traded corporate and consumers. I'm just talking about here in the U.S. Consumers would be unaware that anything happened. And then an article will come out, 1, 2, 3 months later. Oh, we had a breach. And then you get something in the mail and you're like, well, why didn't I know about this sooner? I could have been protecting myself sooner as a consumer where, credit information, bank account information, personal identifiable information that gets stolen from an organization. The sooner I'm able to get that information and know that, hey, a breach happened, I can take steps to ensure that I'm protected. Talking to my banks, credit card providers, knowing sooner is better.
Knowing sooner is better. And I agree because there are a number of countries that have reporting requirements that are less than 4 business days. So that's a great point, Paul. And Ben, you mentioned some insights, and I hope our audience particularly was listening to some of the incisive comments of yours. Finally, gentlemen, I'd like to ask you, what is your choice of the biggest or most important story of the past week and why? Paul, can I ask you to go first, please?
There's a lot of stuff that's been going on out there. We just got reports on U.S. job openings. It topped the forecast. I was just reading an article literally the other day that the risks of recession in the U.S. are actually growing. Several weeks ago, people were thinking, oh, man, maybe we're going to avoid it completely. But I think there's still risks out there. Seeing that these job openings beat forecasts, and this is around white collar positions in particular. This is something that I really didn't want to see. It makes you think, what's the Fed going to do? Well, it doesn't mean that they're going to raise rates again, but I think it means that they're going to hold rates higher for a longer period of time. There are still people out there on the street betting that they're going to Fed's going to cut rates next year. Right now, I don't see that happening anytime soon. So, we keep getting new information that comes out, on a weekly basis. And, I think there's indicators out there where, I was just reading the other day that historically, when people have said, hey, we're going to have a soft landing, what's happened after that is a recession. And it's not long after all that rhetoric that is put out there in print or, on podcasts or on television, wherever the mode or medium is for disseminating that type of thought process. Shortly after that, within, I don't know what the average period is, but not long after that, there has been a recession, and there was data to back up that this had happened over the last several decades. So we are peaking right now with that type of rhetoric. So it makes you think, could next year be a year of a recession here in the U.S.? And I think it's still a strong possibility. The other thing that I see out in the U.S. market, I don't know if this is elsewhere, and I've been thinking about this for a long time from a commercial property standpoint, and I can just see it around my hometown here where I live. Rents are going down in terms of spaces being rented. There are companies that have actually shrunken their footprint within the buildings that they rent. They had 3 floors. Now they have half a floor. Things like that. There could be, a big hit just within the commercial property arena. That will definitely have an impact on the U.S. economy for sure.
Yeah, I definitely echo the higher for longer point. There's a lot of commentary coming out from the Fed that is what they're going to do. So, like you say, Paul, that will be interesting to see, particularly heading into next year, how things settle down or don't. Push, you asked for a top story reflecting on the previous week. So I can't talk about the Men's Cricket World Cup starting in India on Thursday, which is such a shame because I was looking forward to talking about that, but I won't. I'd probably pick up our last couple of stories, really: financial crime, compliance, and just the thought that, sometimes you have to spend money early to make sure you're not spending too much. You have to make sure that you invest in people and processes that can make sure that your organization and your treasury department is completely on top of this issue. Because if you're not and something goes wrong, you've got the initial loss and then you've got a potential fine coming down the pipeline as well. So that was just my thought, spend money early and wisely.
That, I think, is a very thought-provoking comment. And, like you said, better be watchful and better be careful rather than repent at leisure. Thank you so much, Paul and Ben, for your time, your participation, and your incisive analysis. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.